Emily Chang in San Francisco, and this is Bloomberg Technology. Coming up in the next hour, Tesla shares wiping out their year-to-date gains, trading below their entry level in S&P 500. The declines following Elon Musk's comments that Bitcoin's valuation seems high. We'll dig in with Dan Ives of Wedbush Securities. Plus, systemic vulnerabilities in the software supply chain, revealing testimony in the Senate hearing on the SolarWinds hack. We will have highlights of the proceedings, which included top execs from Microsoft, FireEye, and CrowdStrike. And the struggle is RealReal. The COVID-19 pandemic continues to challenge consignment marketplace, the RealReal. It reported a $53 million net loss in the fourth quarter. I'll speak to CEO Julie Wainwright about future demand, plans for growth, and the move to physical stores. All those stories in a moment, but first, Square and Intuit reporting after the bell, and there's some post-market action with GameStop, the CFO resigning there. Bloomberg's Kriti Gupta has more from New York. Kriti, lots of news.
Emily, absolutely. You're seeing a lot of action in the post-market after a fairly quiet trading day. So let's just get right into it. Kicking it off with Square. That's a big earnings story coming after the close. You saw a mixed bag of earnings, but the real highlight there was their Bitcoin investment. 3,318 Bitcoins bought for $170 million. So you are actually seeing a little bit of a decline there in line with that Bitcoin drop. We'll look at a chart and that in a minute. Intuit actually earnings outlook beating estimates. Investors still not hopping into the shares after the close. So you are seeing a little bit of a pullback in shares as well. And then Emily, like you mentioned, that GameStop news, the CFO resigning, definitely pressuring those shares, over 4% of a decline there. Take a little bit of a broad step back, though, and I want to look at what happened with the major averages. Flip up the boards, and we'll look at the S&P 500 marginally in the green. We saw a few tech names be able to lift it higher, but the broad tech story is still a negative one. You are seeing the NASDAQ Golden Dragon Index, which of course is heavy weighted towards tech, under pressure, as well as the NASDAQ 100 and semis down for a second straight session. Flip up the boards one more time, and we'll look at the latest SPAC actually confirming their news with Lucid Motors. Take a look at that 1 month chart, a 472% gain before today's 38% drop, really just pinning that to traders selling the news. You've seen so much anticipation in that SPAC. And lastly, we have to end this with Bitcoin, of course. That is the major risk sentiment indicator, down for a second straight session. And like I mentioned, Emily, Square just recently, right after the close, actually reported that investment in Bitcoin. You're already seeing that not work in their favor.
Right. Really interesting there. Of course, just another day. Bloomberg's Kriti Gupta, thanks so much. I want to get to Tesla now. Shares of the electric car maker wiping out their year-to-date gains. Tesla falling as much as 13% before paring some of that loss. The decline after comments by CEO Elon Musk that the price of Bitcoin seemed high. Tesla has invested $1.5 billion in the cryptocurrency. For more, I want to bring in Dan Ives of Wedbush Securities. Dan, what's your take on this?
It continues to be this double-edged sword with Bitcoin. I mean, they're diving into the deep end of the pool on Bitcoin. And right now, on paper, still a $750 million profit. But it adds more volatility to the name. And that's what you're seeing take place in Tesla over the last 48 hours.
So it wasn't just Elon Musk who said the price seems high. I spoke to Bill Gates yesterday, who cautioned against investing in Bitcoin at all. Take a listen to what he had to say.
Elon has tons of money and he's very sophisticated. So, I don't worry that, his Bitcoin will sort of randomly go up or down. I do think people get bought into these manias who may not have as much money to spare. So I'm not bullish on Bitcoin. And, my general thought would be that, if you have less money than Elon, you should probably watch out.
Not mincing words there, Dan. I mean, do you think the Bitcoin investment was, potentially Tesla getting a little ahead of itself?
I think it was a smart strategic move. And we saw that with Dorsey and Square tonight, obviously MicroStrategy and Saller. And I think this is going to have a ripple effect. I think 3 to 5% of public companies over the next, call it 18 months, will have some sort of investment in Bitcoin. Now, of course, there needs to be some regulatory goalposts put in, but this is not a fad. This is not going away. It's going to start being more mainstream. And as we know with Musk and Tesla, they're going to continue to see forest through the trees. And even though this is going to add to volatility, I think it was the right strategic move, not just from an investment perspective, but transactionally speaking. And I think that that's our sort of view, even though there's some white knuckles at points today.
Right. It wasn't just Gates. It wasn't just Elon. Also, Janet Yellen making some cautionary remarks. And I wonder if that's going to change the kind of investor who's going to want to get into a Tesla or a Square, for example.
Well, that's a great point, because I think that's sort of what we're seeing today. I could tell you institutional investors that I've talked to, they're still a little cautionary in terms of Bitcoin. So they don't love maybe that investment from Tesla, but I still think the majority of investors are fine with it. It's contained. We're talking $1.5 billion, still less than 10% of the cash. I think if they start to go up to 3, 4, 5 billion, that's where it becomes more of a pronounced risk. But still, on paper today, they've made more from that Bitcoin investment than they have from selling all the EV cars last year.
Right. That is just an amazing statistic that I know you pointed out. Are there any other fundamental reasons we're seeing the decline in Tesla? I mean, you've pointed out some other things going on, them stopping taking orders of certain vehicles. How big a contributor is that?
Yeah, right now in the EV market, you're seeing a lot more competitors come in. Of course, GM, Ford, and then you go across the globe, there's going to be many automakers going, and right now Tesla's going to have a target on their back. But we're talking about a $5 trillion market over the next decade, big enough ocean for more than one boat. I think in the near term, Model Y, Standard, that not selling it, even though I view that as a small piece, the price cuts. So you're going to see a lot of the bears come out of hibernation mode. They've been there for the last year, and they're going to come out right now thinking that there's potentially blood in the water. But I still view this as a company that is going to exceed potentially 800,000 units for the year in a golden age of EV on the back of a Biden green tidal wave. That's why I still think it's $1 trillion market cap this year.
Bill Gates actually pointed out that there's an electric car competitor for almost every letter of the alphabet. That wasn't so when it comes to Tesla, came to Tesla 5 years ago. And I wonder, do you see any of these competitors emerging as, truly formidable forces? Could they take a significant share of the electric car market away from Tesla?
Yeah, I think that's starting to maybe go into the risk profile. When you look at GM, I think there's going to be a transformation in GM. I think they are going to be a very successful EV player in terms of everything Mary's done over there. And I think when you start to look at some of the niche players across the board, especially in China with NIO and Xpeng and others, that's going to be more and more share. But if we look today, it's still Tesla's world. Everyone else is paying rent in the EV market. Over the coming years, we're talking $5 trillion over the next decade up for grabs. So it's going to be a pot of gold. Many are going to go after it, but that's why they continue to be leader in the pack. And I just view this as sort of a risk-off trade that we're seeing across the board, Tesla being the poster child in terms of a risk-on momentum name.
Meantime, we've also been following Apple's annual meeting, Tim Cook talking about M&A, talking about the pandemic. Apple also announcing plans to increase the annual dividend. What do you make of that?
And the big focus today is about streaming. Everyone knows they've been massively successful in the super cycle playing out. We also think more products in terms of an AR, VR headset potentially coming out this year. But streaming continues to be the area when you talk about M&A. Do they eventually go aggressive on M&A there? Do they acquire a studio? We talk about MGM, Lionsgate, A24. I think that's a bit of a focus here because right now they are in a massive position of strength, in our opinion, heading to $3 trillion market cap this year on that super cycle. Now, do they go aggressive on M&A?
And what's your outlook on whether or not they do that? I mean, Apple has never made a massive acquisition. A few $1 billion, that's about as high as they've been.
Yeah. Outside of Beats is the largest deal that they've done. And it's not in that DNA of Cupertino, but ultimately in this arms race for streaming with Netflix, Disney, and obviously many other players across the board, for Apple to be a legitimate player here, they're going to have to buy a studio. Otherwise, they'll be a tertiary player. And right now, that window of opportunity continues to be there. And I think that's something that from a sum of the parts, you talk about that, and then the next leg will be EV. We believe in the next 6 to 9 months, they announce an EV partnership. And I think EV could be worth $30 per share more to the sum of the parts of Apple as we look out in the coming years.
All right. The big question is, will they or won't they? What will Apple's play in cars be? We're all anxiously waiting to find out. Dan Ives of Wedbush Securities, thanks so much. All right, coming up, Microsoft and SolarWinds executives among those testifying in front of the Senate Intelligence Committee after a cyber attack disclosed in September, one of the biggest in history. How execs reacted in the hot seat. That's next. This is Bloomberg.
Supply chain attacks are happening as we speak today, independent of SolarWinds, which is the reason why we believe that dubbing it simply as a SolarWinds hack is doing injustice to the broader software community and giving us a false sense of security, possibly.
The SolarWinds CEO there who testified that the U.S. remains vulnerable in cyberspace, this at the first public hearing before Congress to address a massive cyber attack by suspected Russian hackers against the federal government and the private sector. For more, I want to bring in Jamil Jaffer, Senior Vice President at IronNet Cybersecurity and founder and executive director of the National Security Institute at George Mason University Law School. Jamil, I know you were watching closely with your popcorn today, but did you hear anything surprising, any bombshells or new information?
Well, no bombshells, Emily. I think, we saw what we expected, which is obviously a huge attack, or I should say hack, really not an attack against the U.S. government, private sector companies exploiting the supply chain. But I think what was interesting was, Microsoft did make news supportive of data breach notification. I think the real concern for industry is how do we grapple with this new supply chain threat, which has been around for a long time, but it seems to be more aggressively being utilized by, in particular, the Russians, but not exclusively the Russians. A lot of other attackers using this route into our companies, into our government.
Talk to us about the Microsoft development. How significant is that?
Well, look, I think it's something that a lot of industry folks have been talking about for a while. We've seen the expansion of data breach notification laws in various states. And so what the companies don't want, even though they may not necessarily want large-scale data breach notification laws, they also don't want 50 state laws that go after them. And so they'd rather have one federal standard. So not a tremendously surprising development, but certainly a notable one.
Now, there's a lot about this attack, this hack, if you will, that we still don't know. What are you still wanting to find out?
Well, look, we know that the U.S. government, it sounds like the U.S. government's going to give very clear attribution. We know it's the Russians, but they're going to make it very clear and be very solid about that. But the real question is how widespread was this? How many different routes in was this attack against the U.S. government? It's hack against the U.S. government. I keep saying attack, but it wasn't an attack, to be clear. It appears to be espionage at this point. Part of the challenge here is we know that Microsoft was involved. We know that SolarWinds was involved. We know that Mimecast was involved. But it sounds like there may be a lot of other players involved in how the Russians got in and stayed in. It really highlights the need for us to come together, industry and government, to really work collaboratively to stop these kind of threats going forward.
Well, and it also highlights the vulnerability of the software supply chain at this very moment. I mean, can't we assume, we heard the CEO of SolarWinds, they're saying this is happening now as we speak. And what was, perhaps unique about this particular attack is just how patient these hackers were and how long they waited to deploy very sophisticated tactics.
You're exactly right, Emily. This idea that they would spend, months and months getting in and then establishing themselves and really creating persistence. I mean, that's the scariest thing I think about this hack is that not only did they use the supply chain to get in, But now that they're in, they've gotten deep in. They've used Active Directory, other capabilities to really establish a strong foothold. And now they're sort of like the wolves in the henhouse, but they look like hens. And so getting them out and doing that deep network surveillance, identifying the behaviors is going to be really hard. And that's why you've got to have industries working together, companies working together, and the government industry really collaborating and creating this collective defense capability that the Cyberspace Solarium Commission told us about last March.
So what's your sense of how much damage was done? And will we ever know how much damage was really done?
It's going to be hard to tell exactly the scope of damage. We know that they were deep in. We know that they saw, for example, source code from Microsoft. Whether they downloaded or modified it, we don't have any evidence of that yet. We know they got to that. And we know within the government, they had deep sustained access to email and information. Now, there's no evidence they've gotten to the classified networks or weapons systems, but being deep inside our classified networks across multiple agencies can reveal a lot about how an agency operates and what was sensitive to them at the time. Not classified, but sensitive. And so, we may never know the full scope of the damage. One thing I worry about, Emily, though, is the fact that they were in so deep suggests that they could later on, if they had similar access, actually take action or even threaten us with action. They haven't done that yet. That's when it may cross the line and really require a stiff response from the U.S. government.
So what should Congress be doing now? What should the Biden administration be doing now? Anything that they're not already doing?
Well, look, I think, one, we have to make it clear that we're going to push back. This wasn't a cyber attack. This wasn't an armed attack against our nation. It wasn't an act of war. It was significant espionage. But the Russians need to know, if they start to cross that line and come close to even that line, threaten us with something more, disruption, deletion, disabling of our systems, that would cross the line. And they need to know we're going to push back and push back hard. So for right now, sanctions, closing embassies, kicking out intelligence officers, that's the right start now. Down the road, we need to make clear there are red lines. Don't come close to them, because we will push back and we will punch back hard if need be.
All right, Jamil Jaffer, giving it to us straight. IronNet Cybersecurity, thanks so much. As always, good to have you here on the show. Okay, coming up, the CDC sets an emergency meeting for this weekend. At the core, authorization for Johnson & Johnson's COVID-19 vaccine. Plus, guidelines may change for those who are fully vaccinated. Everybody's been wanting to know more. We will have the latest next. This is Bloomberg. Now to the latest in the effort to vaccinate the U.S. population against the COVID-19 virus. Drug makers believe the vaccine could be available to all by this summer if current production plans continue to ramp up. For more on that and other developments, I want to get to Bloomberg's Michelle Cortez, who's been following developments for us. So look, we're waiting for potentially new guidance from the CDC about what we should and should not do, what to do if you've been vaccinated or not. Michelle, what sort of new guidelines are you expecting?
Well, for people who have been fully vaccinated now, we are seeing really very strong efficacy numbers, and the risk that they're going to be infected and that they'll be transmitting that infection are very low. So while we certainly expect that we're going to continue to have to do things like wear masks and social distance for at least the rest of 2021 and perhaps longer, there are other rules that are going to ease up. For example, now we don't have to quarantine. If you've been vaccinated, you don't have to stay away from other people who have been, if you've been in contact with somebody who's been infected. We're going to be able to start having larger gatherings. We're going to start being able to get back into movie theaters and restaurants and gyms in larger numbers. And a lot of the things that have made day-to-day life in the United States and across the world just so much more challenging are going to start easing, and that's going to be happening in the next few weeks, I believe.
So here's the big question, and I know a lot of grandparents and grandchildren have this question, like, can my mom, who is now fully vaccinated, have dinner with our family unmasked?
It's such a great question, and like everything else with this outbreak, I think that it's one of personal choice. I think that public health officials would definitely say that they think that that's not a good idea, because one of the highest risk exercises is doing things like putting drinking and eating, so putting things into your mouth when you're in the context of other people. So you are inviting, a potentially higher risk scenario. That being said, these vaccinations do look very good. If you could do things like eat outside, make sure you have good ventilation, make sure you're positioned so that the grandparents aren't, in any direction from the kids. If you're comfortable with that, then I personally believe that would be a fine choice to make, again, with every precaution you can come up with. That being said, I'm sure that Dr. Fauci and others would disagree with me.
So what about the Johnson & Johnson shot and progress there? How soon are you expecting some sort of authorization?
So the FDA is meeting this week on Friday, actually, to review Johnson & Johnson's submission. The agency could act, almost immediately. We did see with Pfizer and Moderna that they acted within hours, really, to get those out there. The Centers for Disease Control and Prevention, their advisory committee for immunizations, is meeting on Monday to review this as well. So we are expecting that certainly by early next week, we are going to have a recommendation. And at this point, everyone does expect that is going to go in a positive direction. Millions of additional doses are going to be available by the end of next month for Americans. And this is a one-dose shot, making things even more easy to distribute.
Meantime, the U.S. just surpassed 500,000 deaths. If we don't get vaccines until the summer, fully vaccinated, at least here in the United States, until the summer, how many more people could die between now and then?
Well, that's a great question. And I don't think that, especially early in the outbreak, nobody expected that we would be looking at something like this. I remember when everyone was shocked and appalled when the 200,000 death rate was brought up. No one thought we would get to that. And the truth of the matter is that the virus is still widespread in the United States. It is falling. The case numbers are coming down precipitously, and the deaths and hospitalizations will follow that in the decline. But certainly we're looking at tens of thousands of additional deaths, even just among the people who are currently hospitalized and sick with this virus. Okay. So it is really just a heartbreaking thought for those who have gotten infected, who've gotten exposed just in the days and weeks before they would have access to the vaccine.
Totally devastating. And Michelle, thank you always for putting it in perspective for us. Michelle Cortez, who covers healthcare for us. Thank you. Coming up, Facebook backs down in a clash with the Australian government over sharing news on news feeds. All the details next. This is Bloomberg. Welcome back to Bloomberg Technology. I'm Emily Chang in San Francisco. Facebook will restore its news sharing capabilities in Australia after the government agreed to amend legislation forcing the company and Google to pay local publishers for content. For the latest, I want to bring in Alexandra Givens, President and CEO of the Center for Democracy and Technology. Alexandra, curious for your take here. Is this a victory for Facebook?
So Facebook and the Australian government have reached a deal. Facebook will be exempted from the law if they make a significant contribution to the sustainability of the Australian news industry. We may have addressed the face-off that was happening between Mark Zuckerberg and Rupert Murdoch, but the problem is this doesn't address any of the underlying policy issues in the Australian law, and that's something that I think we need to focus on.
What are those policy issues?
So the way the Australian law was going to work is essentially as a link tax. It's going to require major online services to pay for linking to news content. That's confusing, right? Links are actually an important way of driving traffic to news sites, but it's also really problematic when you think about the experience of users online. Linking to information is one of the most important ways we communicate with each other. And linking to authentic news-based information is particularly important as we think about the rash of misinformation and disinformation online. Putting a tax on that in a way that makes information platforms have to pay to link out to that type of information is really counterproductive in terms of the type of behavior it encourages from these platforms.
Now, to that end, the news publishers might say, well, they're linking to our content for free, and we are at their mercy. For example, if Facebook tweaks an algorithm slightly, my traffic can dive. What's your response to that?
Sure. So free independent journalism is essential to our democracy. We need to think about solutions to help address the declines in that industry and make sure that journalists are compensated for the work that they do. But when you do that through a measure like a link tax, it has a couple of really negative consequences. First of all, there's a risk that platforms will respond like Facebook did last week, right? Which is no longer linked to news content altogether. There's a risk that platforms will link only to specific outlets that they've made a deal with, right? So they favor news outlets like News Corp at the expense of smaller independent journalists. And then the last piece, which wasn't an issue in Australia because the effort there was focused on Facebook and Google, but that comes up in other proposals like this that are being talked about around the world, is what happens when we're talking about online platforms that don't have the deep pockets of a Facebook or a Google to pay for these types of links? What happens when we're talking about Wikipedia or Medium or the next service that's trying to connect people online? There, again, disencouraging them or making it hard for them to link out to authoritative news sources is really counterproductive for creating a healthy ecosystem online.
Now, are you expecting a ripple effect here for similar issues to arise in other countries? And is Facebook and Google, are they going to have to strike deals in all of them?
Yeah, so this is not the first time we've seen these types of proposals. They've actually been percolating for about a decade in Europe in particular, starting in the mid-2000s. So even in 2014, for example, the Spanish government tried to force news aggregators to get a license before they included snippets from news articles in their search results. And that ended up leading to Google taking out those snippets, which had a pretty significant impact on traffic to different news sites. So those conversations have been happening for a while. In Europe, I think they're going to continue. There was a provision passed the European Copyright Directive in 2019 that made it easier for publishers to try and enforce this right. So those conversations are going to be happening. And then just this week, we saw Prime Minister Justin Trudeau weigh in on these questions from Canada as well, indicating that they're going to be following suit.
So where do you say this leaves publishers? Are they better positioned as a result of this or not?
They're being backed up by the government to negotiate hard for compensation for their traffic. So when you do see deals being brokered, like the Facebook one or the Google deal, that is in the short term helpful for publishers. I think the big question is which publishers and whether journalists are seeing the benefits as well. When we look at this tax and at the pressure on social media services to pay for linking out to sites, it's going to be far easier for there to be backroom deals for brokered licensing agreements with the publications that people know best. I think that's really dangerous for the ecosystem, particularly when you think about those small media outlets that people don't know to go to independently. They rely on Google search results, on Facebook news feeds and others to help pop people out to those search results to get to their sites. And in these type of pay-to-play scenarios, it's really hard for those journalists and independent news outlets to thrive.
All right. Well, fascinating to watch this play out. Alexandra Givens of the Center for Democracy and Technology, thank you so much for sharing your perspective with us. All right, Lucid Motors, the Saudi-backed electric car maker, has agreed to go public through a reverse merger with a Michael Klein SPAC. But it all is translating into a delay in bringing its car to market. As part of the deal, Lucid unveiled that productions of debut luxury EVs would be put on hold until an unspecified date in the second quarter. CEO Peter Rawlinson told our Ed Ludlow why.
I was pushing like crazy for spring. And when we met with the Churchill Capital team and I took Alan Mully out in the car and Alan drove the car, loved it, the very first car off the production line. We had a meeting of minds with Alan and all his experience from Boeing, with Michael Klein and myself. We all got on like a house on fire and we recognized that, well, Peter, why are you pushing like crazy for this sort of almost artificial state in spring? What's really important here is to get the quality right. You will know when that is perfect, when it will truly delight a customer. And so they freed me. They said, look, get the product right. Don't work to the artificial construct of a specific date. If it rolls on into the second half of the year, we are okay with that. We'll put the capital, You pull the trigger when the time is right. We entrust you to get it right. We know you want to make it perfect. This is a not deal. We're making a luxury car. And you know, when Tesla came to market with Model S 10 years ago, I think a lot of slack was cut then because, you know, the electric car was such a fun experience. People forgave the build quality issues. The market is not going to be forgiven now. This is a very different world. We have to get things right. And the impact of COVID is not to be underestimated here, Ed. So, you know, we're chasing down a number of suppliers from around the world. We have 250 suppliers, 3,000 parts, and that whole infrastructure, logistic operation has been affected by COVID. So that's had a big impact of just pushing it out a little bit into the second half.
Has the global semiconductor shortage had any impact and caused this delay in production?
It hasn't for us because we've had some very savvy purchasers in our purchasing teams who actually preempted this and have negotiated supply agreements which have really mitigated that risk. But I recognize it's affecting some of the automakers, notably Porsche, with their announcement very recently.
What about a cash crunch? I mean, how pressing was the need for you to raise funds prior to this deal? You say in the investor deck that you're going to need around $600 million in terms of bridge financing before the deal with Churchill closes later this year.
There was no cash crunch. We've got a great primary investor in the Public Investment Fund of Saudi Arabia. They're in for the long term. They've got pockets, and they're very supportive of us as strategic investors. For them, this was a validation point, and validate we have indeed. We have attracted the bluest of blue chip investors to validate their original investment. We didn't go to the market needy at all. We went for validation, and that is exactly what we have achieved.
You say in the investor deck that you're going to spend about $10 billion over the course of the next 4 years. That's a lot of money in a short space of time. How are you going to get those additional funds?
Well, we've already brought in $4.5 billion from the Churchill Capital, from the SPAC and the PIPE. We extended the PIPE because it was so oversubscribed. We could have gone for more, actually, and we decided to limit it. That gives us an absolute clear runway well into 2023. And in that time, we can build out phase 2 of the factory. That's capital intensive, but we're investing because we're vertically integrated. And it gets us to a situation where Gravity will be very nearly ready for production.
Peter Rawlinson, their CEO of Lucid, with Bloomberg's Ed Ledlow. All right, coming up, the RealReal's fourth quarter results are out with more losses, but new normal ahead could see the bounce back of the luxury consignment market. We'll speak to founder and CEO Julie Wainwright about her outlook for 2021. This is Bloomberg. The RealReal, the online consignment marketplace for luxury goods, reported worse than expected fourth quarter results, driving shares down more than 13%, total revenue down about 10% year over year. The company saying the pandemic has, quote, temporarily disrupted its path to profitability, but pointed to growth in gross merchandise value. And with vaccines rolling out over the next few months, could the luxury consignment market get back to growth? Joining us now, the RealReal founder and CEO, Julie Wainwright. Julie, great to have you back with us. You and I have talked over the years about how customers love beautiful things, but right now they're not necessarily buying them. What are the numbers telling you?
Well, that's not really quite the right way to characterize it. The truth is, due to COVID restrictions, we've had a harder time getting supply in. And our sell-through is as vibrant as ever, but that all started changing in December. So November, we had a good supply month. December, we started seeing growth in demand. And we also are seeing it in January and February. Again, all of ours, because we're not a manufacturer, we're reliant on getting things from people's homes. It's been very challenging in COVID times, coupled with early on, California shut down our warehouse in Brisbane, which had, a long-term impact because we couldn't pick up units and we couldn't process them in the state of California. Having said that, that was last year. We're already seeing signs of recovery. Starting January was great. February month to date were great. So year to date, we're up 14% in GMV, and we expect to continue for stronger growth in the future.
So if it's more of a supply issue, then what does supply look like for the year ahead?
Well, it started changing again last year, mostly driven by adding our neighborhood stores where people felt very comfortable dropping off. Prior to COVID, most of our supply came from us visiting your home and going into your home. Clearly, that wasn't the best option, and an option many people didn't want during the COVID times. However, people were very comfortable dropping off at stores. So we started introducing neighborhood stores to complement our flagship stores, and it helped drive supply up by about 13%. And it's growing now even more. This quarter, it's grown even more. Year to date, we haven't given out that number, but the growth is there. It's real. We've supplemented that with more vendor products, some vendor product, but still the primary growth in our supply is people feeling very comfortable with dropping off at stores.
So, and our interview, you were on the show, one of the last interviews before lockdown. We were at your store in San Francisco. It was, a wonderful experience, and obviously so much has changed since then. But, you drive by, I see a line out the door all the time. Talk to us about how your physical stores are doing and how you see that contributing to the growth in the future.
So you're absolutely right. I mean, we are adhering to all COVID restrictions. So we have restricted number of people in the stores. We opened a Palo Alto neighborhood store, which only allows 4 to 6 people in at a time. So you can tell it's really constricted. Having said that, the stores are really bouncing back, primarily for supply, secondarily for demand. But I was in New York over the weekend, and I had a driver, I went into our new Brooklyn store, which was incredible, but I had a driver on Saturday take me past our stores in Soho, Brooklyn, and on Madison, and we had lines out the door. So can you imagine once restrictions lift, people are waiting out, it was about 28 degrees, they're waiting out in the cold to go into the store to either consign or buy. I can't wait for restrictions to ease because I think we're just gonna skyrocket. And we've announced by the end of June, we'll have 10 more total new stores open that are more neighborhood focused, which we expect to do very well.
So then what is your outlook on demand? Because, obviously, people love buying, as I said, luxury, beautiful things. But if it is a luxury and people are struggling and many people have lost their jobs, how much disposable income are people going to have to spend on something that they might find at the RealReal?
Well, I mean, there's the facts are in. We had 21% new buyers in Q4 year on year. And the truth is we're still a value versus full price. So when you look at it versus the value shopper, we're still attracting the value shopper. It's an amazing deal and people can resell it. So if people do buy things, they already know the resale value. So in that ways, it's an investment. We saw a very interesting trend during COVID where people were investing in more handbags, fine jewelry, and watches, more so than any other categories. Those categories were up. Now, what we are now seeing, which is positive for us because it's the single largest category, apparel is back. Apparel is back to growing. So, I hear what you're saying. It's, there are hard economic times. On the other hand, there's still a large population that do have jobs and they're value conscious and they're also environmentally conscious. So the combination, I believe, is really going to suit us well. Again, as restrictions ease, and we're already seeing it as they've eased, we expect our business to really take off.
you've done this partnership with Gucci. I know we're coming up on your 10-year anniversary. Let's take it a year out from now, with the development of these new physical stores. How does the RealReal look different, let's say, a year from now?
Well, if you would have asked me that, well, I don't think you did ask me that, but the last time we met, literally 2 days later, we had to shut everything down for weeks. So I don't want to go too far out in the future, because if you would have asked me, we had a pandemic and it would completely sideline our 40% growth that we were having in Q1 prior to the pandemic, I wouldn't have believed you. But I can tell you, we exited 2020 with many more options than we had going into 2020. What I mean by that is neighborhood stores aren't going to go away. In fact, we're sort of revitalizing retail in the neighborhoods we come into. The only other store that has as much action wherever we are is the Apple Store. So neighborhood stores, I believe, are here to stay. Virtual appointments are here to stay for us. And I could go on. I also, at some point, we're going to be international, and that point is, probably, I would say 2022 is our year of international also. So I just feel like the year gave us gifts that we wouldn't have wanted to go through what we did in 2020, because it was a really hard year on us more than other businesses, but we've come out of it stronger with more avenues for growth.
All right, well, we will be watching. Julie Wainwright, founder and CEO of The RealReal. Thanks so much for joining us. Okay, coming up, buy the dip, the hashtag trends on Twitter. Evidence day traders are taking advantage of pullbacks. Plus, the CEO of Robinhood talks about short sellers. We'll talk about the market trends next. This is Bloomberg.
We're very positive on Bitcoin. Again, very happy to see a healthy correction here. No market is straight up. Everyone should know that. Everyone should have some dry powder for days like these. And I've been saying that for a while.
Kathy Wood there of ARK Invest sharing her thoughts on Bitcoin earlier on Bloomberg Radio. She also indicates she's buying the 13% dip in Tesla, adding that, quote, corrections are good. They keep us all humble. As for buying the dip, Kathy Wood was not alone. Tuesday morning's plunge in popular tech stocks offered a rare discounted buying opportunity for true believers. Buy the dip, a popular hashtag on Twitter, with the NASDAQ 100 turning positive after briefly erasing 2021 gains. I want to bring in our cross-asset reporter, Katie Greifeld. So, Katie, how much of the dip was bought?
Well, it was a crazy day, and that buy the dip mentality was definitely front and center. So this was the first time that the NASDAQ 100 has erased a dip of over 3.5% to end just about flat. We haven't seen that since February of last year, when those pandemic headlines first really started to hit markets. And I mean, there's several potential factors here. You have some technicals going on. You also had Jerome Powell in front of Congress. But really what it boils down to is that, again, that buy the dip mentality has really been rewarded over the past year or so for everyone from day traders to Kathy Wood, like you mentioned, coming in and buying more Tesla stock. And that, interestingly, is helping shares bump a little bit higher after hours. They're up over 2% at this point, which is great news for Tesla, since it's been a rough couple of days, down over 10% this week alone.
Meantime, Robinhood CEO Vlad Tenev speaking at the New York Times Dealbook Conference, criticizing short selling. It's an argument we've heard before. Is it gaining any traction?
Yeah, so that's been an interesting byproduct of this entire GameStop phenomenon. So short selling, just to recap quickly, it's when a trader borrows a share of a company and then sells it with the hope that they'll be able to buy it back at a cheaper price. But what the Robinhood CEO is criticizing is that you can buy a share, or you can short a share rather, multiple times. So that's why you saw short interest on GameStop get as high as 140%, which sounds impossible. But again, it's the dynamic that you can short one share multiple times. And so Tenev said specifically that this causes a runaway train reaction. And it sounds like he's describing a short squeeze. That's when traders who were shorting a stock are basically forced out of that position. And there was definitely some of that going on with GameStop. You saw that high short interest level drop down to about 40% when I last checked. So again, it's a debate. There's people such as Tenev saying that, this is bad for markets. Others argue that actually this helps make markets more efficient. It's uncovered scandals such as Enron, but it's going to be really fascinating to see if any actual regulation comes out of this moment in time.
And quickly, just 20 seconds left. GameStop closing $44 a share today. CFO Jim Bell resigning. Do we know why?
Not certain why, but yeah, it was interesting to see that stock move so much after hours after that move. I mean, there's still the fundamental backing that you have Ryan Cohen and other activists joining the board. So we'll see as the market gets a chance to react to that once it opens tomorrow, how that shakes out. But definitely some very interesting breaking news out of GameStop.
Okay. Yeah, something we'll continue to follow. Bloomberg's Katie Greifeld, thank you so much. And that does it for this edition of Bloomberg Technology. We've got Daybreak Asia coming up next. I'm Emily Chang in San Francisco. This is Bloomberg.